top-ranked financial advisor, Treasury Partners Rich Saperstein, to discuss how he's advising his clients. When you see equities like this at a record high, I know you've been pretty bullish, all invested in equities. What do you tell them to do?
Well, the current environment just reinforces the benefits of holding stocks right now. So we have moderating inflation, accommodating Fed, great Q2 GDP and earnings. Next year, we're going to have the benefits of deregulation, tax policy, ease of permitting. So stocks are at highs to reflect a lot of the benefits in the investment climate. So our clients are fully invested with an overweight in large cap technology right now.
What about bonds?
Well, we own municipal bonds. We've been buying bonds for quite a while. And, you know, on an asset allocation basis, when clients have stocks and they keep growing and it becomes a larger part of their portfolio, there's a point where you have to sell some stocks, reallocate into municipal bonds. Notwithstanding the fact that, you know, the market's up 103% over the last 5 years, and earnings are up 95%. So a little bit stretch on multiples, but we think it's an excellent market to own stocks.
Just to stay in stocks?
Absolutely.
And sector specific?
Well, we're long-term holders of technology. It's very important to be in that sector. We're in a paramount period to own technology stocks. We're seeing it today with Oracle.
But it's not all technology. I mean, some of the software stocks definitely haven't kept up.
Absolutely. And look, it's not only software. There's a lot of peripheral names around the primary data center providers. So we own, as I've said previously, the independent power producers. They're in great need because we're under-electrified in this country. And so utilities and the peripheral companies that support the growth of data centers and the electrification of the country are sorely needed right now.
Yeah, I saw the electricity costs were actually one of the contributing factors in inflation today in the PPI. So I guess that trend continues around AI, data centers, investment.
So the ones we own, Vistra, VST, NRG, these companies are generating 9 and 11% operating cash flows. They're $70 and $30 billion companies, so they're small, but they're redeploying that cash extremely effectively. For example, Vistra's retired roughly 30% of their float since we started buying it in 2021. So it's a capital allocation, it's a demand play, and it supports on the periphery the growth in data centers.
I noticed that you recently trimmed some of the asset managers to add to technology. Was that more about the asset managers or about the AI exposure companies?
Yes. So the asset managers had to go because we wanted to add to IBM and Amazon. So given a fixed amount of capital, we had to find a source for it. Plus, the asset managers haven't been trading well, and we wanted to reallocate to more of a large cap tech overweight.
Interesting, IBM is one of the top picks.
Yeah.
I often wonder whether it gets credit for the sort of expanding AI business that it's built out.
Doesn't get enough. Roughly 35% of the revenue is recurring. They have $64 billion total in revenue. It's an AI infrastructure software play. They do AI consulting, and also they're coming out with the next-gen mainframes. So IBM is one of the sleepers. It's down 20% after they announced their last earnings. Probably a good company. Again, peripheral right around the core of data center growth and that whole technology sleeve.
Yeah, and a software play, but not necessarily in the same way that the Workdays and Salesforces are on that front. So what would make you feel less confident? You sound very bullish.
Yeah, we've been fully invested for a long time. What would do that? It would be some, cataclysmic trade war.
But the tariffs in April, when everyone got spooked, that didn't make you nervous?
They've been tremendously overblown because they haven't shown up yet in the inflation. I've heard the end of American exceptionalism, capital flight. Everyone's going to sell U.S. dollar assets.
Well, the bond market got a little jittery for a minute.
For half a minute.
Yeah.
Okay, but Look, for example, if inflation comes in higher than expected, right now in the market, Fed cut is probably reflected in stock prices right now. So,
I think 3 cuts this year now is reflected, right?
Yeah. So, if inflation is a surprise to the upside, that could be a tail risk event. But right now we're following earnings. Earnings have been growing. Cash flow is very strong. And, that's what's keeping us in the game.